All right. So oil prices jumped to $115 a barrel over the weekend on Hyperliquid as the Middle East conflict and the sudden production cuts from Kuwait and the UAE rattled energy markets. So as of course, this spike on Hyperliquid unfolded while the traditional commodity exchanges were closed, giving crypto-based traders a chance to react first to the escalating geopolitical tensions tied to the U.S.-Israel conflict with Iran and the mounting disruptions near the Strait of Hormuz. So crypto traders flooded Hyperliquid as the geopolitical headlines intensified. They pushed open interest on oil perpetuals past $50 million at times, and they sent daily trading volumes above 100 million during the peak activity. When the traditional futures markets reopen here in another 8 hours or so, prices could very well drift back towards levels supported by the physical supply and demand, but there's a possibility that those price spikes seen over the weekend stick. And as we've discussed, David, this trading action seen on perps dexes, decentralized perps dexes, is offering a glimpse into how quickly markets can react now when geopolitical risk collides with this always-on trading infrastructure.
Yeah, I wrote about this a lot in the newsletter, obviously, last week, because this conflict broke out going into last weekend, and Hyperliquid and Bitcoin in particular were the kind of the two places for everybody, not just in crypto, to express their opinions or hedge themselves over last weekend, right? And so you saw a massive spike in volume on Hyperliquid. You saw movements in Bitcoin that preceded the movements on last Monday, and it was interesting to see the reaction. You had people on crypto Twitter both be excited about this, like, look, this is the future of finance, right? Hyperliquid is. Oh yeah, by the way, also Bloomberg last weekend, not this weekend just passed, but the weekend before that, when the conflict broke out, Bloomberg over the weekend was citing Hyperliquid in their market sentiment analysis over the weekend, which is, I think, is maybe the first time that that's happened. So they were talking about oil and what they thought oil would do come Monday morning, and the basis of their thoughts were from the oil contracts, I guess, on Hyperliquid, which is, again, it just shows you that we're kind of entering this kind of new era where it's no longer just for crypto. It really isn't. It's now for everyone, and it's being used by everybody.
Yeah, macro moves now being played out on the decentralized exchanges.
Now, the downside to this, which I thought this was interesting, again, I also mentioned this in my newsletter, was right now Hyperliquid and then crypto, like digital assets, are really the only way people in all markets can express their opinion, or go risk off during these now kind of standard weekend moves, right? I think governments have realized the best time to do any kind of market shaking events is on Friday night or Friday afternoon after U.S. hours have closed, because it gives time for the news to digest, and then by Monday, the reaction is a little more measured usually. So then all of that kind of volatility that happens is expressed through digital assets, and this is perhaps not a good thing for Bitcoin and crypto, right? Because of all that.
Yeah. In the past, the expression has always just been through the marquee crypto assets like Bitcoin. Now, with these perp dexes with derivatives products for commodities like oil, you can express it, your whatever your macro view is on the asset itself, not just at like on the proxy Bitcoin or Ethereum. So arguably, it's the Bitcoin reactions to the way that Bitcoin has always reacted to these geopolitical events first may now be muted because there's other ways people can express it in the perps dexes.
That's true, except again, they're not as liquid enough really yet. And so Bitcoin often becomes kind of this volatility absorber, you could say. Again, I just thought it was an interesting counterpoint to the prevailing narrative that this is like an unmitigated good for Bitcoin and crypto. So it's a small point. I would like to just speak a little bit about like I'm going to put on my monitoring the situation hat here and speak way outside of my expertise, Graham, if you will. So oil, right? This thing about oil, we're all concerned about it. The price of oil has skyrocketed in the past like 30, 40 days from below 60 up to 100 plus.
Yeah, currently trading at $117.
Yeah, pretty wild. And you have the two benchmarks, right? You have WTI and you have Brent. WTI is the US based kind of version of the price, and the Brent is more of a international Europe, Middle East, Asia version of the price. Often what happens when there's conflict, especially in Europe and the Middle East, is Brent will trade at a premium to WTI. It's just because it's maybe a little harder to get because the theater of conflict is in Europe or Middle East or Asia, and that makes sense, right? It'd be it'd be a little harder to get to those resources, and that had been happening up until I just saw a post this morning. I don't know if it's still happening, but it looks like because of this issue with the Strait of Hormuz, that specifically Asian governments, Asian market participants are now trying to gobble up WTI because their access to the Brent oil is going to be severely impaired. At least they're planning for that. And so you're having a situation now which is not so normal, where Brent was higher than WTI, right? The European international version was higher than WTI. And then it's now flipped the other way around because of the Strait of Hormuz problems. And this is apparently some of the oil people I follow kind of more dangerous, or it sets up a more risky situation because it means that some of these sophisticated players they're predicting impairment for 2 to 4 to 6 weeks, right? And this kind of move doesn't usually happen unless they think that there's a decent chance that it'll be hard to get oil from the Middle East. So that's not looking good for the price of oil.
Right. Now, what does the price of oil, like, how does that affect we're Bitcoin focused podcast here. What are the permutations, right? So the price of oil goes up. I think that means that inflation is likely to spike. And therefore, that means it's less likely that there will be rate cuts, which therefore, according to traditional wisdom, at least, or historical precedent, means that risk assets, aka Bitcoin, are likely to underperform, right? Rate cuts. If there are less rate cuts, there is more risk off, and Bitcoin underperforms.
Yeah, right, exactly. So, I mean, we have this story from Arthur Hayes. He said last week that, I guess in a piece, he argued that a continuing conflict between the U.S., Israel, and Iran could end up being bullish for Bitcoin because he thinks the Federal Reserve might respond by printing money. And I think what you're laying out, Graham, is the counter argument to Arthur Hayes, right? He says that major geopolitical conflicts often lead to easier monetary policy. There is some history of this where the Fed cuts interest rates or injects liquidity into the system to keep everything going. Government spending increases to support the war effort. This does make sense, and there is some historical data to support this. He points to the Gulf War and post 9/11 as examples of this happening. However, just as you said, Graham, oil spiking this hard, inflation being one of the kind of the key things that this Fed has been laser focused on since post COVID. This is the inflation is like the big boogeyman, and this will definitely increase inflation. And you've already seen this with like prediction markets and the what's it called, the interest rate. I forgot the name of it, but the interest rate markets. The June contract was in favor of rate cuts. That has now dropped to about 50-50. I bet it'll continue to drop here on out. And so now the next most likely target for a Fed cut is September, right? Which is a long time from now. And to add to this, Graham, you're seeing finally the dollar start to rally from this conflict, right? People, big funds, everybody gets a little worried. All these mega institutional investors with lots of money, they start to get a little worried. They de-risk out of emerging markets, out of these other local currencies. They go to cash, they go to dollars. Dollars starting to catch a bid. Everyone's been short dollars for like the past 12 to 18 months. This is only going to strengthen the dollar. Dollar going up is usually bad for risk assets, and traditionally Bitcoin as well. It also makes liquidity scarcer, right? A more expensive dollar means there's less dollars usually. And so liquidity tightens. This is not good for risk assets. This is not good for Bitcoin.
So several things aligning here, it seems, against Bitcoin performance, at least in the medium term here. Perhaps on the other side, the argument would be, and people have been pointing this out, is this increased geopolitical uncertainty, conflict is something that is often pointed to as a reason to hold Bitcoin. Now, the fact is that Bitcoin hasn't performed as that sort of risk off hedge, I guess, really ever. But if there's always that possibility that the narrative will shift.